Welcome to episode 4 of the Retire Ready podcast, the podcast that helps Canadians prepare for all that retirement brings. I am your host, Scott Sather, founder, president, and financial planner at Awaken Wealth Management, and portfolio manager with Awaken Investments of Aligned Capital Partners in Regina, Saskatchewan. Thanks for joining me today. Today is part 3 of a 4-part series I'm doing on financial advice and what to look for in an advisor. We're going to talk about the exciting topic of advisor fees. Yes, you are paying fees. Even if you don't see them coming out of your account or receive a bill for the services, no one works for free. So we're going to discuss what options are out there, what is a fair or reasonable fee to pay your advisor, and which of the options makes the most sense for you. So why are we talking about advisor fees on a retirement podcast? Well, as I mentioned in episode 2, many investors look for retirement advice and planning from financial planners and advisors. So it's important to know what options there are for fees so you can come into the client-advisor relationship with eyes wide open. Now, everyone measures the value they receive from a product or service differently. Everyone values their time differently, and everyone has different levels of complexities. Nonetheless, the value you receive from something or someone, however you measure it, should be in line with or even outweigh the cost. With this in mind, when it comes to evaluating the cost of advice or a service, what's important is that you feel that you receive value from it, that those costs are transparent, and most importantly, they're explained in a way that you can understand. Unfortunately, in the world of Canadian financial services, this is where things can get murky and complicated. That's because fees are not always transparent, and they're not always explained or communicated well. And sometimes the fees are intentionally structured or explained in a confusing way so that the retirement investors don't actually know what they're paying or even how they're paying it. You might have thought I was joking earlier when I said there are financial advisors or financial services salespeople who say they don't charge fees at all. But unfortunately, that wasn't a joke. Now, while I can't control how all the planners and advisors in Canada structure and communicate their fees, I can do my part to educate folks so that if and when you need to hire a financial advisor, you are equipped with the knowledge and information required to make the best decision for you and your family. So that's the goal for today, to educate and try and provide you with clear information about the different ways a financial advisor might structure their fees so you can make an educated and informed decision on what's best for you and your situation. Okay, so just before we jump in, I want to emphasize 3 things. First, contrary to what you might read or hear in the media, there is no perfect one-size-fits-all fee structure. Every fee model can be a disservice to someone. Second, all fee models contain some sort of conflicts of interest. And lastly, once again, there is no such thing as a free service, and definitely not a financial product. Even a guaranteed investment certificate or GIC has a cost. Believe it or not, the banks like to make money. The only time there may be a free service is if you're taking advantage of a pro bono advice offering through an organization like the Financial Planning Association of Canada pro bono listing. And there'll be a link in the show notes for that page. To simplify things a bit, we can break down the fees to 2 categories of fee structures used by advisors: transactional fees and ongoing fees. In the transactional fee category, we have commissions and the hourly or project-based fee schedule, otherwise known as fee for service. By transactional, I mean that you're paying a fee or commission for that product or service. It's not an ongoing continual fee. You pay a single fee in return for a single transaction or service. As a result, you can decide for yourself how frequently you want to engage with that transactional advisor, knowing that each time you do, you will pay a fee. Then there's the ongoing fee category, where we have fee-based account fees, or the percentage of investments being managed fee, also commonly referred to as AUM, or assets under management fee, and the less likely to be seen in Canada option of the annual retainer or subscription fee model, also referred to sometimes as flat fees. Like I said, this is less seen right now in Canada. However, it is a growing way advisors are paid south of the border, so we will likely see it as more of an option in the future. And I refer to these as ongoing fees because you are committing to an ongoing service model. You're paying a predetermined ongoing fee with the intention of being a long-term user of the services being provided. So 2 categories and 4 different ways a financial advisor might charge for their services. And as previously noted, there is no perfect one-size-fits-all structure. Each one has its benefits and drawbacks. Choosing the right financial advisor and the right fee structure will depend on your unique needs, goals, and situation. Let's break each one down by starting with the transactional fee category. So, commissions. This can cover a lot of the Canadian financial advice landscape today. Commissions can be visible, meaning you see the cost up front, or in your transaction confirmation or statements, or often hidden within the product you purchase. They're typically a one-time cost when you purchase or are sold the product. These can be for most products or solutions offered, such as stocks, bonds, mutual funds, exchange-traded funds. You get the idea. If we go back 30 or 40 years, this was really the only option available to investors. You buy a stock or a mutual fund, and the commission, sometimes as high as 9.5%+, would be taken right off the top. So you'd stroke the check for $1 million, 90,000 would go to your advisor, and the remaining 910,000 would be invested in the fund. Yowzer. Going back in my career to the year 2000, when I first started out as a financial advisor, working for a large global brokerage firm, we would sell front-end load mutual funds where you'd pay a 5% upfront commission. So if you were investing $1 million, 50,000 would be the commission paid to my dealer, of which I would get 40%, and 950,000 would then be invested in the fund. Now, in my defense, I didn't have any other options back then, nor did I really know any better. That's just the way it was. There also was a benefit in that if the client purchased the fund this way, they would receive a lower management expense ratio, or MER, on the fund. In some cases for mutual funds, they may be sold with a zero upfront or no load commission, and then the advisor would receive ongoing fees called trailers to continue to look after you. This is what you would typically see if you're just investing through your bank or credit union, which can lead to many thinking they don't pay a fee. Up until the last few years, many advisors use deferred sales charges, otherwise known as the DSC. These were crafted back in the 80s to help advisors sell mutual funds. Many people obviously didn't like the idea of having to pay that upfront fee and not having all their money go to work for them in the investment. So the fund companies came up with a way to still pay advisors that high upfront commission of 5% or so, but have the full amount invested. In this case, the investor would be stuck with the fund company usually for 7 to 8 years, so that the company could recoup that commission paid through the management expense ratio, or MER. If the investor was to leave the fund company beforehand, they were faced with the sales charge that was usually on a sliding scale. So if you got out in year 1, you'd pay a 7% fee, year 2, a 6% fee, all the way through to year 8, where there would be no longer a fee. They also had the ability to draw out 10% each year without having to pay the fee to allow some liquidity for those investors needing income. Many investors were not fans of having their investments tied up with a single company for that long. So in the 2000s, the low load option became available, which saw a smaller upfront commission in the range of 1 to 3%, and investors only being tied up 1 to 3 years with the company. On top of both of these upfront commissions being paid, advisors would also get a trailer fee as well to continue to look after the client of 0.5% in the case of the DSC for equities, equity funds, and 1% in the case of the low load or no load, which also would pay that trailer. So in that sense, there's kind of a mix in some of these products being sold where there is a commission, but then ongoing fee to the advisor after that. Thankfully, as of June 1st, 2022, regulators banned the use of the DSC funds for mutual funds, and June 1st of this year, 2023, for segregated funds. Although some on the insurance side have come up with other ways to get paid upfront, known as chargebacks, which again, regulators have put a stop to. Now, if you're working with an insurance advisor, you are likely paying commissions, although they are almost certainly not transparent. Most insurance products like life, disability, and critical illness policies, annuities, and segregated funds are commission-based products. So life insurance, as an example, pays an upfront, usually fairly large commission to the advisor, usually 60 to 80% of the first year premium, and often with an override over and above that as well. And then ongoing reduced commission paid out annually. Principal protected notes, bonds, and even GICs sold through an advisor or broker will have an embedded commission paid out, but the yield or quoted rate will already have that factored in. So if the GIC says you're getting 5%, you are getting the 5%, and your advisor is getting a paid commission on top of that. Now, I'm not saying commissions are bad. In fact, if you're needing insurance, which for many people is an essential part of managing the risk in their financial plan, you have to work with an advisor who will be paid a commission. My issue with commission is where companies try to incentivize advisors offering higher commissions, therefore causing conflicts of interest. In an ideal world, these would all be disclosed and all would be good. Unfortunately, it's not an ideal or perfect world. So if someone is offering to work for free, chances are they are being paid a hidden commission. Just ask them to disclose it, how they're paid. And if they won't, then find someone who will. Okay, after all that, now we could talk about the fee for service side of things. This makes up the other member of the transactional fees. You'll usually find this with fee for service advisors and planners. This can be ideal for those who invest on their own and are wanting a third party to do some planning or help to see if they're on track with their goals. This is usually a limited engagement, hence why we include it on the transactional side. You'll typically know upfront what the cost will be and what services will be provided for the fee. This is often quoted at an hourly fee or a flat fee for the service and usually doesn't include any products. Some of the advisors may offer products as well, but often they just offer planning services and leave it to another advisor or the client themselves to implement the plan. With this fee option, you're typically cutting a check or having the fee charged to your credit card, which can make it less of an option for those younger folks who are just starting out. Coming up with $2,000 to $5,000 for a fee when you're just starting to invest a couple $100s a month might not make as much sense to the individual's pocketbook. Again, it's a great option to get a second opinion or get a plan that isn't tied to products, but it can still come with some conflicts, such as the potential of the advisor dragging on the engagement to increase costs. This, I would think, would be less likely. I would say the biggest drawback to this type of fee is the potential for folks to be hesitant to call for advice. Think of it the same way as your lawyer or accountant. You may have questions, but the answers come with billable hours, meaning an invoice, likely at the end of the conversation. The only other issue being that the implementation of the plan being left to the individual to get it done. I've seen many folks over the years procrastinate when it comes to things like getting their wills and powers of attorney done, simply because the next step is in their hands to complete. Okay. Let's cover recurring fees. The most popular option here in Canada being the fee-based or asset-based method. This type of fee is transparent, as you will see the amount deducted from your investment accounts on a monthly or quarterly basis. Historically, 1% of assets has been a popular fee charge. So if you're investing $500,000, the annual fee is $5,000. You'll see $416 be taken as the fee from your account if you pay monthly, or $1,250 if you're charged quarterly. This fee will also have GST added to it, and if the investment's in a non-registered account, it may be tax deductible. This isn't the case for registered accounts like the RSP or TFSA, as the government figures they're already providing some tax benefits on those accounts. Now, the fee can be higher for small accounts, maybe 1.25% or 1.5%, and possibly being as much as 2%. But typically you see the fee go down with the more total money you have invested, getting well under that 1% amount. Now, by account, I mean the investor's household. So think husband and wife and any joint accounts. So this can include RRSPs, tax-free savings accounts, RESPs, corporate accounts, and so on. The total of all the assets is what the fees will typically be based on. Sometimes this fee is all inclusive of trading and admin fees, but often those are on top of the fee. As well, there is the product fee. So if you hold mutual funds or exchange traded funds, ETFs, we'll talk about that in a minute. One of the benefits of this option is that your advisor has some skin in the game, so to speak, meaning if your account goes up, the advisor makes more, and if it goes down, the advisor makes less, just like you. However, a risk of this fee method is you could be working with someone who is taking the fee, but really not providing any value or service. This comes back to what we mentioned before. You have to find value in the fees you pay. Often the fees are quoted in percentage, which can lead to sticker shock for folks. when they see the actual dollar amount being deducted from their account. So it's good to either ask your advisor up front or do the calculation of what that dollar amount looks like before signing up. Lastly, there's the retainer or flat fee model in the recurring fees. This is harder to find in Canada at this point, as very few advisors offer it. It can be beneficial in that you pay a flat fee, usually on a monthly or quarterly basis. And again, it's paid via check, credit card, or directly debited from your bank account. This can result in it, again, possibly not fitting for those just starting out. A nice part of it is that it's disclosed up front, so you know your fees. The downside can be if your investments go down in value for a period, you could be in a situation where you're still paying that same fee even though you don't have as much invested. Even worse could be if you lose a job or go through rough times with a business, and right at the time when you need advice, you don't have the income to support paying the fee. Now, I've talked about the fees advisors are paid, but we've missed out on the product fee. I've mentioned management expense ratio, or otherwise known as MER, you'll hear several times in this episode, but haven't explained what it is. I'll save a more in-depth explanation for another episode, but it's basically the cost paid to the company that is managing the fund. Part of the fee can also be paid to your advisor in the case of a DSC or no-load funds, but that cost is stripped out for the fee-based funds, also known as F-class. Even everyone's beloved ETFs or exchange-traded funds include this MER, and it can include, in some cases, an embedded fee or trailer that is paid to your advisor. This comes back to episode 2, where we talked about finding and working with a real financial advisor or planner. We'll chat a bit more about that in our next episode. Okay, I think that covers our topic for today. If you have any questions or would like any retirement-related questions answered on future podcasts, please email me at info@awakenwealth.ca. Be sure to subscribe and give us a review on your favorite podcast player. You can also subscribe to the Wake Up semi-monthly newsletter by visiting the Awaken Wealth site, which is awakenwealth.ca. Be sure to check back in 2 weeks for our next episode, where I'll be wrapping up our now 4-part series on finding an advisor and answering the top questions you've asked. Thanks again for joining us today. I look forward to seeing you back for the next episode.
Thank you for listening to the Retire Ready podcast. To subscribe to this podcast or to learn more, please head on over to awakenwealth.ca/Retire Ready podcast. Investment services are provided through Awaken Investments of Align Capital Partners Incorporated, an approved trade name of Align Capital Partners Inc. /ACPI. Only investment-related products and services are offered through ACPI or Awaken Investments of ACPI and covered by the Canadian Investor Protection Fund. Tax planning, financial planning, and insurance services are provided through Awaken Wealth Management Limited. Awaken Wealth is an independent company separate and distinct from ACPI or Awaken Investments of ACPI. Awaken Wealth are not licensed tax professionals, and you should consult with your tax advisor before acting on any recommendations. Investments and investing strategy should be evaluated based on your own objectives. Listeners of this podcast should use your best judgment and consult a financial expert prior to making any investment decisions based on the information found in this podcast.